All right, welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker SWKS, Skyworks Solutions, company we've covered a few times on the channel before. Even been a proud owner of it once before, not currently, but always very interested in keeping my valuation of this company up to date, being that it is a pretty well-known player in the semiconductor space, major in some ways, not necessarily super major in other ways, but it is particularly known as being a major supplier of Apple, though it has done a pretty good job of diversifying its business away from being primarily Apple and also going into some other specific spaces, which we'll get into in just a little bit. I also put together a pretty good revenue model, I think, for the valuation to build up the overall projections for the company. But as I said, before we get into that, looking at our watch list here today, this week I made some more purchases on Monday, as I typically do. I bought a little bit more Smith & Wesson, which I've been buying pretty regularly throughout the last couple quarters, and also made a little bit more purchase of FG, which is the recent spinoff of FNF, which is one of our largest holdings and has been our largest holding for quite some time. FNG being a partial spinoff of a section of their business that they're doing. But I've been buying up some shares of FG in particular because it allows me to essentially diversify that holding away from one section of their business to another section of their business, and effectively what I think is similar to what the owners of the business themselves are doing. But beyond that, I've really just been trying to be really selective in those purchases. I've been trying to build up cash a little bit while kind of waiting to see what happens with the rest of the market. The market obviously took a little bit of an interesting pullback after the Federal Reserve meeting, even though the rate increase ended up being 50 basis points, as was kind of expected. But the market at the end of the day still saw that as a rate increase nonetheless. And so we'll see how the rest of the year plays out, whether or not we get a little bit more of a Santa Claus rally, or if the early parts of December was basically the only rally we were going to get there in particular. So before they're getting into the valuation itself, one other thing I kind of wanted to point out was we also got a little bit of economic data in today. In particular, we got some new housing starts information, as well as building permits. Building permits came in a little bit cooler than was expected, but the housing starts came in as expected, effectively, technically a little bit higher than expected, but pretty negligibly higher. So basically as expected, but which is still slightly down from the previous month. But either way, it kind of shows that housing starts have somewhat plateaued around this 1.4 million per month level. Which is interesting to see, considering interest rates are still at relatively high heights, but obviously the increase in the mortgage rates has kind of paused for the last month or two, and so at least it shows that they have plateaued at the current level, seemingly, or so. Obviously mortgage rates could continue to go up in the future, so we'll see what happens with that, but I would look at that as relatively a strong reaction that the housing starts are coming in the same as they were the previous month and the month before that, and as expected, especially given that their mortgage rates are still way higher than they were at the start of the year. So just an interesting point of data to point out there. So we can get straight into the valuation for Skyworks, as we typically do when covering a company. I start with some basic information about the company before getting into the valuation specifically. The company was founded in 1962. It is on the Nasdaq exchange here in the United States, with its main currency obviously being reported in United States dollar. I have their main websites listed here for easy reference. The current CEO, Liam Griffin, has been CEO for quite some time, joining the company in 2001. He was actually elected as CEO in 2016, but he, as I said, has been with the company for quite some time, well past all of the entire time frame of the historic period we'll be taking a look at for the company. Being part of the semiconductor industry, their top customers, as we kind of already mentioned, is Apple, which is really the lion's share of business for them, but they are, as I said, also diversifying into many other customers. Some of the other major players that they sell their products to being Amazon, Cisco, GE, Sony, Broadcom. You can list a million other companies, Ericsson, Garmin, a million various other companies in the electronic spaces, various companies that provide IoT devices, and also the automotive companies more and more as well. Top competitors being ADI, Broadcom, Cirrus Logic, NXP, Qorvo, Qualcomm, Texas Instruments. There you could also name many other players, but a lot of these kind of smaller scale chip and RF chip producers are all competitors of them, relatively speaking. They're next exported to report on the 20th of January, assuming that they'll also have their call in at that point. They're typically release their filings within a day or two of that, but we don't really have a full confirmation on that. The guidance that they provided for the first quarter is that they expect to have $1.325 billion for their overall revenue, and also they're guiding a midpoint for adjusted EPS of $2.59 for their EPS for the first quarter, and also expectations of about 51.5% of gross margins, as well as they also provided the expectation of about $192 million in operational expenses, which if you compare that to their current operational expenses, not counting depreciation and amortization, and cut it in force to turn it into a quarterly amount, you get pretty close to that number. So effectively they're telegraphing a similar level as the last year or so in operational expenses. According to the analysts on Yahoo, there's expectations of about $5.1 billion in revenue for the overall year next year, according to 28 analysts, and $5.52 billion for the year after that, according to 23 analysts. That comes out to being adjusted EPS of $9.79, according to 28 analysts, and then $11.10, according to 23 analysts for the year following after that. The trailing 12-month dividend that they've had over the last year is $2.30 over the entire year, but they did increase their dividend to 62 cents per share, which annualizes up to $2.48, which is 2.77% of their current share price. They also have $1.1 billion of share buyback authorized, which equates to about 7.5% of their current market cap. So all combined together in the next year. So you could theoretically potentially see a 10% total shareholder yield, although that would imply that they did the whole share buyback within that year. And to be honest, Skyworks, while they do buybacks pretty significantly, they're also relatively a little bit more judicious than some companies, I would say. So you wouldn't necessarily see them do that whole 7.5 within 1 year's time frame. Their current shareholder insider holdings is relatively small at about 0.3-0.4% of total share count. However, it did increase pretty significantly by about 35% within the last 6 months. So somebody in the company has been noticing the lower share prices and been appreciating it. About 78 to 79% of the company is held by institutions, and there's currently about 2% of the shares outstanding are out on float, coming up to about 2.5% or so out off of the total float relative to the outstanding number. And the short ratio is currently 1.76, so that's about 1 to 2 days or so that the shorts have on hand. Not really a huge amount of leverage point time for the shorts and needed in order to call. 3-month average volume is about 2.2 million versus the last 10 days has been about 2.9 billion. So there has been a little bit of elevated volumes in the last 10 days relative to the last 3 months, which could indicate that maybe it's not necessarily the greatest time to buy, but obviously that is a little bit dependent on the type of volume activity. For example, actually, I was looking relatively closely at some of the insider buys and sells, and there actually has been some major sells within literally the last week. So sometimes you just have to look a little bit closer at the details in those things. So with that, we can get into a few details that I want to cover specifically from their Q4 report here, just kind of covering the overall activities of their year, talking about expansions that they're planning to do with different companies, expanding away from specifically communication devices into other devices. We were talking about other segments of their business, specifically IoT devices and automotive and infrastructure devices, making some plans with Amazon, as well as other producers with Google and Samsung, as well as Frontier Communications. Very, very exciting to see that. One other thing I did want to point out, regardless of the fact that they are doing a good job of diversifying their business, they still have significant risks associated with that. It's like in some ways it feels like the conversation surrounding Skyworks is actually a little bit ahead of it, because like they used to have such a huge concentration in their business on Apple that even a small amount of diversification away from it, people have already started to reward them pretty significantly. But if you get into like the concentration section of their 10K, which I have right here, they get to some of the specific details which are worth noting. As they say right here, in fiscal 2022, Apple, through sales to multiple distributors, contract manufacturers, and direct sales for multiple applications, including smartphones, tablets, desktops, notebook computers, watches, and other devices. See, that's like the key thing that's important. Most people are focusing specifically on the fact that they're in the Apple phones. But even though they've diversified the segments of their business into non-communication, non-phone parts of technology, they're still being an Apple customer, even in those sections of the business, like in the notebook computers, the watches, and other devices. In aggregate, for Apple, 58% of the company's net revenue in 2022, 58% of the company's net revenue was effectively sourced through Apple through one form or another in 2022. down from 59% in 2021 and down from 56 or up from 56% in 2020. And then there's the other catch, the thing that's more important. It's like net revenue is one thing, so 60% of the revenue is coming from Apple. But what about previous revenues in the past years? Because like obviously we see these ratios right here, but like it was even higher in the past. And you know, previous sales, sometimes you only get that cash coming in a little bit later. As of September 30th, 2022, the three largest accounts receivables comprise 79% of aggregate gross accounts receivable. This concentration was 70% in October 21 and 70% in 2020. So 79%, 80% of their accounts receivables came from three customers, which, you know, you can basically assume that that mostly comes from Apple. So just one thing that's worth pointing out is like they have a huge reliance on Apple. Their entire, not entirely, but effectively more than half of their business is focused around Apple, and basically how fast Apple grows and also the pricing power that they have relative to Apple is going to decide the type of revenues that they're going to have in the future. So we can start to take a look at the actual valuation I put together for Apple, starting with the discount rate and the segmentation of the business. As we've kind of already been talking about, we're thinking of them as part of the semiconductor industry. If we come over to my spreadsheets for industry data sets, the US industry data set that I have right here, I pulled open the semiconductor industry and the semiconductor equipment industry just because it's a related industry right here. But we can focus mostly on the semiconductor space, which is what they are. The adjusted unlevered beta for semiconductors is currently 1.09. So that's going to be the beta before adjusting for leverage that I'm going to be using for Skyworks. They have relatively low leverage, but that is what it is. And then the sales capital ratio, which is down here, I typically rely on the 3-year average for the sales capital ratio to get a little bit more of a semi-recent, but still a bit of a term average approach to like what is the capital efficiency within an industry currently right now. And currently the capital efficiency for semiconductors in the industry in the United States is 0.75. What that means is that those companies are receiving about 75 cents in revenue for each dollar of invested capital that they have in their business. So that's what we're going to think of as kind of an average for thinking about where Skyworks ought to be. And then adjusted net margins, which is adjusted for R&D capitalization. I like to look at a little bit more of a longer term average. I have up to 8 years for this particular data set. Longer term because cycles can kind of affect the margins of things. The adjusted net margin on average for this space seems to be about 19.5%, about 20% or so. One other thing I kind of wanted to point out, just like relative to that, I was kind of like looking at this, just thinking about some of the differences within here, is just thinking about, for example, right here, I have the total market capitalization for this sample set, which is 67 companies, the total market capitalization being about $2.4 trillion versus the total industry sales for those 67 companies being less than $300 billion, which is effectively price to sales of over 8. Which is pretty interesting to see, especially if you think of like over here, I have the entire market, not counting financial companies. So it's reflective of mostly the entire economy, which is 5,600 companies. The total market cap for this grouping over here is 47 trillion versus 16 trillion in sales. So you can see the price of sales for the entire market is close to 3. So just giving you a sense of scale of just how expensive semiconductors currently are in terms of prices to sales relative to the rest of the market. Just a price of sales of 8. Pretty up there. Of course, that's not necessarily super relevant to Skyworks in particular. Skyworks is not a super expensive company in general sense. Some other things I kind of wanted to point out before we moved on from here is also the gross margins, which was going to be relevant for looking at Skyworks. The gross margins on average for the last 5 years for semiconductors has been about 55-56%. And then also debt to equity ratio, you can see on average for the space has been about 10%, 11 to 12%, maybe on a longer term average, depending on which space you look at. So if we come over here to my spreadsheet for Skyworks, as I said, the unlevered adjusted beta that I'm using for the company being 1.09, as we put in right here. That 1.09 is then adjusted for the 17% debt to equity ratio that they currently have. Again, we were seeing that the industry currently has an average of maybe about 9 to 12%, depending on what range of time frame you're looking at. So they have a little bit more debt than their industry typically has. 17% or so. That brings the levered beta up to 1.25. So that's going to be the beta that I use for the company and the valuation. I also build up their equity risk premium based off of the geographies in which they get the revenues and where they hold their assets. They have 67% of their revenues coming from the United States, about 10 to 11% coming from China, 4% from Europe, Middle East, and Africa. Man, I really hate it when companies combine Europe, Middle East, and Africa into one geographic area. It's like you can just tell that they basically just like threw everything else together in one group. Anyway, 8% in South Korea, 7 to 8% in Taiwan, and then 1% in the rest of Asia. Altogether, that gives me an equity risk premium before adjustment of 4.49. And then production, you get relatively a similar disbursement of revenues, but pretty different in some areas. For example, we only have 19 to 20% of their assets in the United States versus, like, as we saw, about 65%, 67% of their revenues coming from the United States. So there's a little bit of a disconnect between the amount of assets they have in the United States versus the revenues they get there. That partially has to do with the domiciling of the companies from which they get the revenues. For example, Apple's a United States company, so all of the Apple's revenues from them would be counted as US revenues, effectively speaking, even though Apple is going to be selling their products globally. So you're going to see a little bit of some divergence in that effect right there. But anyway, you can see that the lion's share of their assets is actually held in Japan, 54 to 55%, which is pretty interesting to see. Kind of an not, you know, a lot of companies hold a certain selection of their assets in Japan. Like, that's not uncommon, but it's usually like 5 to 10% or something like that. So for a major player like that to hold 50% of their assets in Japan is a little bit interesting, in my opinion, especially considering they're not a Japanese company. Mexico, 23 to 24%. That's also a little bit of a relatively high percentage to see for that particular company, whether in this industry or not. Definitely pretty interesting to see. They have a pretty high amount of reliance on manufacturing there, and then also 1.5% in the rest of the world. Taking those weightings together of production revenues and then adjusting the ERP for the current space in the year that we're currently at, I end up with an equity risk premium of 6.44. Having some problems speaking there today. That brings my total cost of equity up to 11.5%, effectively speaking. And they also, as we already talked about, the leverage required them to get to their debt to equity ratio. That leverage comes from about $2.4 billion that they currently have in total debt at a weighted average maturity of 5 years and about 2%, a little over 2%, which is pretty impressive for them to have interest rate that low. You know, they used to basically have no debt for the longest time, and then the last 2 years, partially to take on some acquisitions of Silicon Labs and a few other places, they did take on this much debt, $2.4 billion, which is, as we said, a little bit more than is pretty typical for their industry. But man, did they get some pretty good terms. 5 years isn't the greatest. It's not as long as I would necessarily like, but it's not terrible. It's at least it's not super short term. But 2% interest rate, man, is that impressive. They managed to really lock in really good financing for that. But that makes their weighted average cost of capital down at just under 10%. So we will take a look at 10-year period of their history that I have built into this valuation for the historic period. Starting with their revenues, you can see they went from $1.8 billion in revenues in 2013 up to $5.5 billion in revenues in 2022. For the first 5-year period of their growth, they grew at about 16.5% per year. So they had a very fast growth during the first 5-year period of our historic period. And in the last 5 years, it's been more like 8.5%. So you could look at that as them slowing down as they've grown into scale, but you could also look at that as being an effect of the kind of cyclicality that you get in the semiconductor space. There tends to be large spurts for 2 to 4 years, and then for 3 to 4 years, maybe a little bit of a lull period where revenues don't seem to grow. For example, you can definitely identify a space like that where they had about $3.2 to $3.3 billion up here in 2015, 2016. They technically went a little bit higher than that up to into 2018, up to 3.8 to 3.9 billion, but then back down to 3.3 billion or so in 2020. Although, of course, you could blame that partially on COVID, but there was also the decline in 2019. So that's part of the reason I bring it up, is that decline was kind of already in place there. There was already a little bit of a lull in this 2018 through 2020 period before skyrocketing up again in the last 2 years. Looking at the gross margins, now we had identified in our data set that the average gross margins in semiconductors in the United States was about 50 to 55%, depending on the time frame you look at. And you can see that pretty consistently over this entire time frame, they've had lower gross margins. For the first 5-year period, they averaged gross margins of 47%, and then for the next 5-year period, they averaged gross margins of about 48.5%. So there has been a little bit of an increase in gross margins, though it has had a little bit of cyclicality to itself in and of itself. But you can see that it kind of follows. In fact, the heavier growth periods a little bit, the downward movement in revenues coincided with a downward movement in the gross margins, but either way, still below the industrial average of 50 to 55%. Coming down, we can also take a look at their adjusted net margins, which for adjusted net margins, because it requires R&D capitalization, I only have about 6 years worth of accurate information for their R&D capitalization, because for the net margins prior to that, the R&D capitalization isn't fully tuned in, so we can't really look at it in full apples to apples. But either way, taking a look at the last 6 years worth of R&D capitalization, and the average margin they had was about 28 to 29%, which is
pretty outstanding, especially considering the margins that we saw for their industry was closer to 20% for the last 8 years, or maybe about 22% for the last 5 years, since that's kind of the time frame we're looking at. But 22% in the last 5 years versus the last 6 years for them is 28%. Even if we look at the last 5 years just to make it super precise, it's still 28%. So 22% to 28%, that's a huge improvement on overall net margins, which is pretty interesting to see, especially considering they have lower gross margins. So by consistently having lower gross margins than their industry, they still manage to pull off much higher net margins after adjusting for R&D capitalization than their overall industry. And I think that partially has to do with the overall levels of R&D that they're doing relative to the revenues. Their overall revenue R&D has actually grown pretty dramatically at a faster clip over most time periods than even their overall revenue, except for basically the last 2-year period. However, it seems to have started from a relatively low basis, which means as a percentage of revenues, it's still a relatively small number. I actually don't have that specifically up here, but for example, in 2013, we can pull it up. The R&D as a percentage of sales was about 12 to 13%, and then in 2022 the R&D as a percentage of sales ended up being about 11%. So even as a percentage of sales over the 10-year time frame, it seems to have shrunk a little bit, at least from the basing of those specific 2 years. And if we look at R&D as a percentage of sales for the industry for the last 5 years on average has been about 18%. So R&D as a percentage of sales isn't very high relative to their industry, and I think that's partially where they're getting a little bit of a higher net margin. But the same thing can also be said for SG&A as a percentage of sales. So they seem to be just making a large amount of their savings back on their overall net margins off of the back of these operating expenses. So if we come down to the cash flow statement, we can take a look at the amount of that they've been reinvesting for growth depending on the various time frames. Now I've generally talked about this adjusted net capex number line that I have right here as being a combination of capital expenditures minus depreciation plus any cash spent on acquisitions plus any changes in working capital, as well as the R&D capitalization effect built in all into one boiled number to get an idea of just how much of your actual net profits that they're reinvesting into their business. For the first 5-year period of their business, hold on a second. I'm having a little bit of a formatting issue. It's gonna hurt my ability to calculate it there. For some reason, the spreadsheet likes to put the format into a date sometimes, which is really frustrating. One moment. For the first 5-year period, the average adjusted net capex that they spent was about $330 million per year, and for the next 5-year period, hold on a second, I'm gonna have to do the same thing. For the next 5-year period, the average adjusted net capex ended up being about $1 billion or so. So you can see that there was actually a pretty significant increase in the overall levels of capital expenditure being done in the business, effectively a tripling over from the first 5-year period to the second 5-year period of the amount of their profits that are being reinvested in the business. For example, for that last 5-year period, we can see that the average net income that they had was actually 1.2 billion. So effectively, they were putting $1 billion per year back into their business when they had about 1.2 billion per year to do so, which means effectively 80% of their net income was being reinvested in the business. And that's at the same time as they were still doing a decent amount of share buybacks and dividends. And so the real question is whether or not they were actually issuing enough debt per year to also make up for that fact. For example, for the first 5-year period, they were taking on only about 52 million per year. As we already talked about, they didn't really have a whole lot of debt, but in the last 2 years with the recent acquisitions, you can see they actually did take on 2.2 billion, specifically in 2021, which means that over the 5-year period, it ends up being close to about 500 million per year that they were actually taking on. The amount of cash flows that they could have paid off their shareholders for the first 5-year period was 617 million per year, and the amount that they did pay out to the shareholders was 417 million. So they did well in the first 5 years. The next 5-year period, the amount they had to pay out to their shareholders was 650 million per year, and then the amount that they did pay out their shareholders was 936 million. So they definitely have been overpaying their shareholders in the last 5 years. And again, that's mostly because they've basically just been paying out their shareholders as usual, effectively speaking, even though they took on this $2.2 billion in order to do the acquisition. And the acquisition itself was $2.7 billion. So that means even so, they still had to pay some cash out of hand effectively to do that. And not to mention whatever levels of reinvestment they were going to also do that year as well, because that wasn't going to be the only form of reinvestment that they did that year. But either way, 5 years, in the most recent 5 years, well, we can give them a little bit of benefit of the doubt if they are still doing well over a long enough period of time. As we saw, they were being responsible for the first 5 years. So if they're being responsible enough to the full 10 years still looks pretty good, then we can generally give them the benefit of the doubt. For the last 10 years, the average cash flows that they could have paid out was 634 million, and the average amount that they did pay out to their shareholders was 676 million. So still a little bit too much paid out over the whole 10-year period. Again, you could just say, oh well, it's just because of the acquisition, but even so, it makes me question what they're thinking. For what reason were they doing $940 million worth of share repurchases in this year if they didn't have that cash on hand, effectively speaking? Yes, the share price had been coming down significantly, so it might have been a judicious point to be doing so, but at the same time, you have to be able to bring that cash into the business. So I would be a little bit cautious of that, but like I said, their history prior to literally just the last 2 years showed that they were being pretty responsible with their cash flow. So I would in general say that that's mostly just because of 2021, but still something to be cautious about in the future. So looking down at the returns on invested capital, we can see for the first 5-year period, they had about 32% returns on invested capital. So they were receiving massive returns on invested capital for those first 5 years. However, it doesn't have the full effect of the R&D capitalization. So it might have been a little bit lower than that, maybe closer to 30%, maybe even 25 to 30%, but still pretty high returns on invested capital. And then for the next 5-year period, which does have the full effect, in the average ends up being about 20%. So still very, very high returns on invested capital, but we can see that it is somewhat trending downward over the period of time as they start to scale up in their business. The returns on equity doing likewise, with the returns on equity in the first 5-year period being close to 33%, which is basically in line with the returns on invested capital, which makes sense considering they didn't really have much leverage going on at that time. So you wouldn't really see too much leverage effect. The returns on equity for the last 5 years, however, has been 22 to 23%, which is decidedly higher than the 19 to 20%. So you can see that they are starting to get about 3 to 4% worth of return on equity boost due to the leverage, which is what you would like to see from leverage in the first place. So good to see that. Now coming down to the balance sheet to take a look at how things are over here, we can see that their cash levels have ebbed and flowed throughout the cycle. You can see that actually, for example, they started with about 500 million in cash on hand in 2013, and then that level peaked in 2017 at about 1.6 billion. So even though a lot of the companies we looked at have had peak levels of cash in 2020, when a lot of companies were kind of trying to get a lot of cash on hand, that's not exactly what we see with Skyworks, which is pretty interesting to see. In fact, they had about 567 million in cash at the end of 2020, and then they had even higher levels of cash in 2021, and then they managed to put some of that cash to work in 2022. And it's worth noting the cash levels in particular, because I was in fact just being critical of the fact that they were doing that much share buybacks last year, even though they were doing about 940 million worth of share buybacks, even though they only had about 734 million worth of free cash flow to equity after debt equity cash flows coming into the business. So even so, they did liquidate about 300 million worth of the cash off their balance sheet in the last year, but it seems that they still have a pretty healthy level of cash relative to where they've been historically speaking. However, obviously that doesn't take into account the growth of their business in general. They do also have a pretty significant growth of accounts receivable over the 10-year period. You can see going from an average of 400 million of accounts receivables for the first 5 years to an average of 666 million in the last 5 years. And then in the most recent year, it ended at over $1 billion in accounts receivable. Now, in general, that would be a little bit of a worrying sign, especially since we don't necessarily know the credit quality of the people who are the accounts receivable payers. That's the thing about receivables, is that it's profit that the company has booked, but they haven't received the cash yet. So you need to be sure that the people who owe them the cash can actually pay them back the cash. Now, when it comes to Skyworks, the thing is, we actually do know who the majority of those accounts receivables are. At least half of that accounts receivables comes directly from Apple, which gives, I would say, Skyworks a little bit of some wiggle room. Not in the fact that they're going to receive that cash; they're still just going to receive that cash whenever Apple decides that they're going to receive that cash, which puts them at the weaker end of the discussion table as far as that's concerned. But either way, Apple's like one of the most highest credit companies on earth. They have higher credit than the vast majority of governments, and they have so much cash on hand that it's not really a problem. So it's like one of these things where not really a problem there. You can definitely count on them getting that $1 billion, effectively speaking. Whereas some companies, that might be a little bit more worrisome. It might be possible that some of that gets canceled backward, the profits getting written backward. Comparing receivables to payables, that's always something we want to do. We can see their payables have also grown over time. Their payables averaged about 197 million for the first 5-year period, and then they averaged about 265 million for the next 5-year period. So actually not that dramatic of growth of payables, all considered, considering the amount of growth that the business itself has done, ending at 323 million. So overall, I think their payables look really, really good. You can see they also did pick up a small amount of short-term debt. As far as other assets they have on hand, inventories, that's always the big question that we need to be paying attention to. The inventories they had on hand was about 337 million on average for the first 5-year period. And for the last 5 years, the average on hand that they had was about 800 million. And then they ended the most recent year with $1.2 billion in inventories. So that's a big worrying sign. That's something that we've been pointing out with lots of companies, is that you got to be concerned about companies that are growing their inventories too dramatically. And then I will say, it's like coming over to our industry data set, and we also have, so that we can pay attention to that in particular, inventories as a percentage of sales for the semiconductor space has averaged about 12% pretty consistently throughout various time frames. It seems like that's a pretty consistent number across the space. So 12% is kind of the number that we would be looking for as far as inventories to sales. I have the inventory to sales by year for Skyworks written up here. You can see that it goes from 13% in 2013, averaging about 12% for the first 5-year period, and then averaging about 18 to 19% for the next 5-year period. So we're already getting a little bit more. That's definitely, see, the first 5-year periods, they were about in line with their industrial average. And then these last 5 years, man, their inventory has been growing and growing and growing and growing. And then now they're up to 22%. 22% inventories to sales, which is almost double of what you would expect to see for their industry. So definitely a big worrying sign for Skyworks is their inventories to sales. Again, the one caveat to that is that their customer being 60% Apple means that you can theoretically maybe have a little bit more of a understanding of where those inventories are going to go over time, where the demand is supposedly going to go. Of course, that's going to depend on Apple's revenues. So we'll get into that when we get to revenue projections. So it's like you can maybe give them a little bit of a benefit of the doubt for some of these accounts receivables or something like that. I mean, hell, if you were to take this and take 65% of what that number is, I forgot the sign, you would find that if you say 65% of their accounts receivables, that'd be 14%. So maybe 14% of it you could say belongs to Apple in particular. And you say, well, what's left of it after the Apple amount? Well, then there would only be about 7 to 8% left over after the Apple amount. So it's like, if you just count Apple as being totally fine, and then maybe like half of what's left of it you see as a worrying sign, then you can maybe say 3 to 4% is a problem. Again, that's doing a little bit of some legwork for Skyworks executives. So you're giving them some decent benefit of the doubt as far as that goes. So yeah, inventories, I would definitely be concerned about that. The one thing, the other thing I would say that gives me a little bit of some grace as far as for allowance for their inventories and the receivables has to do with the fact that, yes, in fact, they did also do those acquisitions. You know, they did the large acquisition in 2021, which means there's still going to be some a readjustment to the overall balance sheets as they readjust to the overall levels of revenues that are growing with that acquisition. They did, in fact, have huge growth of revenue, 52%, partially off the back of this Silicon Labs acquisition, and some of that still stretching into the growth of 2022. So it's possible you could also say that this growth of inventories has to do with the fact that some of that expected revenues from Silicon Labs has not shown up yet, so that this ratio will start to come down over time. Again, I'm doing a lot of legwork for Skyworks here. That's definitely a worrying sign to be had for them. So coming down to their equity statement, seeing how their overall balance sheet has evolved over time in terms of actual profits built in, you can see that their shareholders' equity averaged $3 billion or so for the first 5-year period, starting at about $2.1 billion, and then it averaged for the last 5 years about $4.6 billion or so, ending at about $5.4 billion. So there is a pretty consistent growth of the shareholders' equity over the last 10 years, which is what we like to see. And then retained earnings has also grown pretty consistently, starting at about 300 to 400 million in 2013, and then averaging about 1.6 billion for the last 5 years, and then growing up to averaging 4.7 billion in the last 5 years, up to 5.4 billion or so in the most recent year. So they've done a good job of retaining earnings, despite the fact that they've done those share buybacks that I said were maybe a little bit too much in the last couple of years, and despite the fact that they're paying out those dividends, and despite the fact that they are building up their inventories and their receivables. Though I would say the building up their inventories and receivables is actually somewhat related to this, because as I was saying, is that some of that is profit effectively being booked in advance. Well, at least for the receivables, not for the inventories. But the point is it shows that they have done a good job of at least balancing out the growth of the assets relative to the liabilities over time. So with that, we can actually start to take. Oh, actually, I'll take a quick look at the history of the sales capital ratio for them. So the sales capital ratio, which we use as our measure of capital efficiency and our measure of how much a company needs to reinvest their profits in order to grow for a company, for the first 5-year period of their history, you see their average sales capital ratio was actually over 1. Now again, sales capital ratio is how many dollars of sales for each dollar of capital invested in the business. So a sales capital ratio of 1.6 means they're getting $1.06 of revenue for each dollar capital invested in the business, which is pretty good. Typical, 1 is a pretty good drawing line of something being good or not. A low sales capital ratio, less than 1, high sales capital ratio, higher than 1. Though obviously it depends on the industry. Some industries just are what they are. We had already seen in my industry data set that the industry average for sales capital ratio for semiconductor space is 0.75 for the last 3 years. So for the industry, it's about 0.75. So for the first 5-year period, Skyworks was doing actually better than their industry. And then you can see for the next 5-year period, the average sales capital ratio that Skyworks had was actually about 71. So it dropped from over $1 to 71 cents for each dollar of capital invested in the business, which means it dropped below their industrial average. In fact, the industrial average we were basing that off of was the 3-year average, and the 3-year average for Skyworks was actually 63 to 64 cents. So significantly lower than their industrial average. Now, the real question is whether or not that they're going to grow back up towards their industrial average over time, whether or not this is them effectively building in capital into their business ahead of time, and then eventually that sales is going to start to build back. In fact, it also could be argued that effectively they had done a poor level of reinvestment in the first 5-year period, and so they were riding off of the previous investment from prior than that, and effectively they were getting a little bit behind themselves in terms of reinvestment. If we take the average over the entire 10-year time frame, for example, we end up with 88 to 89. So 89, which would be 89 cents for each dollar of capital invested in business, which would be better than their industry, but also worse than they were in the first 5-year periods and better than they were in the last 5 years. Now, I'm going to argue that it's a mixture of these things. I do think that they are likely to have a lower sales capital ratio than their industry, partially because they have such good margins relative to their industry. And I've typically shown that when an industry has low sales capital ratio, they typically have a relatively high margin relative to the overall market, and vice versa. And then that's true on an individual company level more often than not, where you'll find that a company that has high net margins will often have a relatively low sales to capital ratio to kind of balance these things out. The market doesn't let a company be amazing at everything more often than not. There are exceptions, and most people know about the exceptions because they're usually some of like the best companies just operationally. But whatever, the point is I can see Skyworks bringing their sales capital ratio up from the current levels, because I do think that this is partially sagged down because of the high levels of reinvestment they've done in the last couple of years. But I do think they will also typically have one lower than the 75, which is the average for their industry. So over time, I can see it growing upward back into the 70s. I have it moving towards an expected ratio of 0.72, in fact, on a range from 0.5 to 0.75, leaning towards 0.75, and that gets me an expected range of 0.72, which I'll get into the probability distributions in a little bit. But that'll leave it below the 0.75, which is their industrial average. So that's going to be my projections for capital efficiency. Got a little bit ahead of myself on the capital efficiency one, but since we were already talking about the sales capital ratio I figured I would just mention that detail right now. Starting with the rest of the projections I have for the company, we will actually go over to this other page here where I've put together a model for the revenue growth of Skyworks, kind of 2 different ways of kind of looking at it. I'll show what I mean. So what I have here is the last 10 years of their business, and the revenue is here at the top. I also have their year-over-year revenue growth, as well as 3-year compounded growth rates and 2-year compounded growth rates to kind of take a look at different growth periods throughout time and compare them to things. But then also I took from their 10Ks over the last 10 years, the number, something that they report when the business section talking about their overall business overview. They report just how many components that they produce as a total throughout their business by year, and they also report the rough number of total customers that they have in the business by year, and they also report the amount of patents that they currently hold as an industry. Now, it's just something I've noticed following Skyworks and analyzing them as a business for the last 5 years or so, is that they very much look at their growth of their business as stemming directly from the growth of their patents. They do a large amount of R&D, as we already discussed, and the R&D functionally makes itself into patents. A decent amount of these patents are not going to pan out as far as being able to be turned into successful components that will then also be sold to customers. So as you can see, there's kind of like a chain of effect here. It's like patents lead to components, lead to customers, lead to revenues. The fact that they released all this information in their 10Ks, I was just kind of reading through the 10Ks, noticing that they kept showing these numbers and showing the growth of the customers and the patents over time. And I was just like, that's interesting. What happens if I take these patents and customer numbers and then break down the growth of those numbers over time and see just how much the revenues can be said to have correlated with the growth of customers and patents over time. So that's basically exactly what I did. I basically took the correlations of different segments. So like right here, I have the correlation between revenues and customers. I have the correlation between revenues and the customer growth versus the ratio of customers to components. And then I also have the correlation between revenues and patent growth, taking a look at the correlations of different segments over time, but then also looking to see which one had the strongest explanatory power, being the coefficient of variation. Now, the point of this is to try to project growth of the future. So what the point of the one factor of doing this isn't to just see, oh, well, of course the revenues are going to grow as they grow more patents. The question is if they grow their patents in 1 year, what does that have an effect on the revenue growth in the future? So what I wanted to do was see not only their correlations in a single year, but also offset by 1 year, 2 year, or even 3 year. And that's effectively what I did. I built a model showing that there's a 1 year offset, a correlation between the growth of the patents and the revenues 1 year later. You can do the same thing between the 3 year compounded growth of patents and the revenues 1 year later. But then there's also a 2 year offset between the patents, the ratio of patents per customer to the growth of revenues over time, and then a 3 year offset as well for that number. A bit complicated of a statistical method, but effectively it allows me to project based off of the patents per customer that Skyworks currently has in the most recent year to make projections about the revenue 2 to 4 years out. So with this method, I weighted all of my projections outward. I have one model of a 32% projection for the next year, one model for an 8% projection for the year after that, a 5% projection for also the year after that, 12-year projection for 2 years after that, and then a 6-year projection for 3 years after that. And if I weigh them all together by their coefficient of variation, I end up with a 5-year projected compounded growth rate for revenues of Skyworks based off of the amount of patents per customers that they've had over the last 3 years of 8%. So that's the projection I came up with. Like I said, a bit of a complicated statistical method to try to build up potential future revenues based off of patents and components that they currently build, which, like I said, it's a little bit of a unique method. You could totally argue that it isn't even all that meaningful, especially since it doesn't take into account the macro environment and actual specific customers. It's effectively just saying that Skyworks is going to grow based off of their own R&D and the growth of their own in-house development of components through their own in-house patents. So like I said, you could argue that it's completely irrelevant because it doesn't take into account the macro environment. For example, like I said, the 1 year offset projects that the next year the revenues would be 32%. And here we are in the macro environment where most people are projecting a downward increase, a decrease in revenues. For example, the analyst estimate that we had for next year being about 5 billion, which is a 7% decrease in revenues. So that's just worth noting. It's you should take this with a grain of salt. It's based off of pure statistics and not necessarily looking at just the empirical data without necessarily thinking rationally about the actual market itself. But either way, that's a projection of an 8% compounded growth for the next 5 years. Now, I did build a somewhat of a second method, which is just taking a look at their overall segments of their business and then assigning different coggers to the different segments to kind of think about it in a different way. Just a little bit more of a simplistic method. I broke down their overall revenues of about 5.5 billion into, they have the mobile revenues and then the broad markets, which the mobile revenues they said is about $3.5 billion of their current revenues, which means 64% of the most recent revenues came from the mobile markets. And then that means about 36% came from what they call broad markets, which is effectively the other parts of the business that they're trying to diversify into. The broad markets are divided into IoT, Internet of Things, auto industrial, infrastructure defense, and audio gaming, which based off of their presentation they have on their website, I estimate the percentages that they have off of the pie graph that they show there of being 58% of the broad markets being IoT, 26% being auto industrial, 8% being infrastructure defense, and then 8% audio gaming, which means the overall percentages for the business of those segments being 21% of their business IoT, 9% auto industrial, 3% infrastructure defense, and then 3% audio gaming. So with that gets me these revenue amounts off of the most recent year. And then I just assigned, like I said, this is a pretty simplistic method. I already had the more complicated statistical method up here, which gave me an 8% compounded rate. But if I assign different revenues, different COGR revenues for these different sections of their business, and then just weight them all together. I'll start with IoT because it's simpler to talk about. I give a 15% COGR to IoT because it's approximately twice the rate that I'm assigning to mobile revenue, which is 7%. And then the 7% mobile revenue COGR is actually based off of my Apple valuation I have right here. I have Apple growing their revenues at a 7% COGR from my most recent Apple valuation. And so I'm just going to put that revenue growth rate right in there so that these two valuations are consistent with each other, because they should be consistent with each other. Obviously, they could grow a little bit faster or slower than that. I'm just putting 7% in there. It's simple enough. IoT, like I said, I'm just going to simplistically assume that they're going to grow about twice as fast as mobile revenues. That's my random estimate. You could argue with it however you want. I put 10% for auto industrial because I think that they also will be growing faster than mobile revenue, but maybe not twice as fast. So I just put 10% in there roughly. I think infrastructure defense will probably grow at about the rate of the economy. So I put my risk-free rate in there, which is my proxy for the growth of the economy. And then I put 15%, basically the same logic as IoT for audio gaming. I think that they could grow maybe twice as fast as mobile revenue. And so if I use those COGRs, this gets me my revenue projections for 5 years out based off of that. And that gets me $8.5 to $8.6 billion in revenues 5 years from now, which equates to a 9.3% COGR of revenue for Skyworks. So I have two different methods, a kind of empirical statistical approach, which gives me an 8.3% COGR. And I have a relatively simplistic segment future projection method based entirely off of my own assessments of those different segments of the business, giving me a 9.3% COGR. If I mix the two together at a simple average, I end up with 8.83%, and that's basically the projection that I'm going to use for my assumptions for Skyworks. I put in the 3-year average of the revenues for the most recent year to kind of give me the downward decrease in revenue that we're expecting in the most recent year. As we had just talked about, the analyst projections on Yahoo says that they're expected to get about $5.1 billion in revenue. I have it down to 5.2 billion, so maybe they'll do a little bit better than that. You could argue about the details here. You could say that's maybe one small benefit of the doubt that I'm giving them there, but either way, I then have it growing at a 3% rate. In the worst case scenario to a 19% rate. In the best case scenario, the selections of these numbers are pretty random. Basically, I'm just saying that in the worst case scenario, the revenues are going to basically be the same as they are in 2022, and in the best case scenario, their revenues are going to be basically twice as much as that. But really, I was just trying to get my expected COGR to be roughly equivalent to my estimate that I came up with my projections here. So effectively, I just cut that number in half and then gave it 50% more for the greater end of it, so that the midpoint would get me basically to where I wanted it to be. I also leaned it towards 14% so that the expected revenue would be so. So that's my expected revenue for Skyworks 5 years from now, about 5.2 billion or so, 8.5% COGR or so. The probability distribution that I'm using, I am a little bit more optimistic than pessimistic for Skyworks. In general, they've done better than I expect, and I think of them as a pretty high quality semiconductor company that's really, really well run and internally developed for the most part. So I'm leaning 20% towards the more optimistic model versus 10% on the more pessimistic model, with a little bit more excess weighting towards the middle too. So it is a little bit more weighted towards the optimistic end of things, and that's partially how I end up at this weighted COGR is post that weighting. Coming down to the margins, this is where things get a little bit more tricky, because it's one thing to make projections for revenue growth, but making projections about the costs relative to them is always a little bit more complicated. I decided to rely on statistics a little bit for this one as well. Taking, for example, the standard deviation of the overall margins that we have over this entire over our historic time frame, and then taking 3 times that standard deviation, and then adding back in an average of the R&D adjustment to basically give me an expected margin range based off of their historic range. So basically, I'm just going to rely on their history to give me a lower bound of possibly 17% and an upper bound about 36%. I rounded it off to 15 to 35%, and then I have it leaning towards 30% in the more optimistic model. That gets me an expected net margin of 26 to 27%, which is pretty much exactly where their margin currently is in the most recent year. So I'm effectively just assuming that they're going to keep the same margins they have currently, and then they're going to grow at the rate that I had already assigned to them. Now, we also already discussed the sales to capital ratio. And my projections for that, I have in worst case scenario it being at about 50 cents for each dollar capital invested in the business. And in the best case scenario, I see them going towards their industrial average, and I'm leaning towards them going towards their industrial average in kind of the more optimistic weight of it. And that gets me an expected ratio of 0.72, which is lower than their industrial average, but definitely moving back up towards it overall. With these assumptions, we also have a debt to equity ratio assumption, which we already talked about how they're currently at a 17% debt to equity ratio. So I have it going from a range of 25% in the worst case scenario to possibly 0% in the best case scenario. They've had 0% debt in the past, so it's not unreasonable for me to assume that they could choose to go back to that by paying down all the debt that they took on with their acquisition. And then I see them actually, and more likely than not, just staying in about the same range at about 15%. So it's going to kind of lean basically around that range or so. With these assumptions, we basically end up with basically no default risk, about 0.5% or so, pretty negligible amounts of default risk. And across all these assumptions, that gets us to a return on invested capital of about 19%, which is pretty much in line with what they've done over the last 3 to 5 years, as we've kind of already discussed. So we're effectively assuming that they're going to stay pace in terms of revenue growth, in terms of margins, in terms of return on invested capital. In many ways, we're assuming these next 5 years will look very similar to the last 5 years. So with all of that, that gets us to all the assumptions in place. So we can come over here to our summary page of our valuation. I will ask, if you're watching live or on the replay, it'd be really appreciated if you could give us a like. It's the number one way that you can effectively pay me for this content, is give me a like. Liking the stream helps attract more viewers to the channel and helps pump the algorithm in my favor. Also, if you are watching and you haven't already, please subscribe to the channel. Subscribe and hit that notification bell to make sure you get notifications whenever I go live or whenever any other content is released on the channel. And if you've done both of those things, please consider joining the Discord. It's the pinned comment in the chat. It's also in the description below. Join the Discord. You can be part of the daily discussions we have there surrounding what's going on in the markets, various things going on in our portfolios or projects that we're working on, even sharing some memes or company analysis on the actions of individual investors. So things like that. Come join the Discord, be part of the discussion there. Make sure you do all three of those. Subscribe, like, join the Discord. So with that, that brings us to the overall valuation of Skyworks, SWKS. The 10-year treasury currently selling at 3.57% as our risk-free rate, equity risk premium for mature markets being 5.65%, and the discount rate they come up to for Skyworks specifically after adjusting for company-specific risks is 11.32%. The current cash dividend being 2.77%. 5 years ago, they had sales of $3.65 billion. In the most recent year, it was just under $5.5 billion, equating to sales growth of about 8.5% per year for the last 5 years. Sales capital ratio they currently have is 0.62, which again is 62 cents for each dollar of capital invested in the business. That's 62 cents of revenue for each dollar of capital invested in the business versus their industrial average of 75 cents. So a bit lower in capital efficiency relative to their industry. Returns on invested capital for the last 5 years on average has been about 20% or so, which is pretty impressive. And they currently have a debt to equity ratio of about 17%. Default risk in the most recent year, it was effectively zero. And profit margins, they currently have about a 26.5% margin compared to their industrial expectations of about 19.5%. So as I had said, they have a bit lower sales capital ratio than their industry. They're not quite as capital efficient as the rest of their industry. However, they do have excess margins relative to their industry. So there's usually a little bit of give and take for most companies within their industry and also industries within the economy on that particular dichotomy or scale. The current profit being $1.45 billion, a pretty significant amount of profit in the most recent years, and they're currently selling for $89.60 per share. The probability distribution that we're using for our valuation is twice as weighted towards the fourth optimistic model versus the 10% that we have in the second more pessimistic model. So we have a little bit of excess weighting towards more optimistic possible outcomes that we see for Skyworks. We are a little bit more bullish, relatively speaking, on them. We do have revenue projections of anywhere from 5.3 to 5.4 billion in the worst case scenario to possibly 11.1 billion in the best case scenario of revenue. On an expected basis, we see 8.2 billion. That equates to sales growth of effectively flat, less than 1% downward per year in the worst case scenario to possibly 15% per year in the best case scenario. On an expected basis, we see about 8.5%. Then we also see sales capital ratio on expected basis about 0.72. So as we had said, we see them returning close to their industrial average in terms of capital efficiency, but not quite reaching their overall industrial average. And returns on invested capital, we see them hovering in this 19% range, effectively on an expected basis. Debt to equity ratio, we see coming down a little bit towards an expected basis, about 12%. Although it's worth noting that decrease of debt to equity ratio might have more to do with their market cap adjusting, not them actually paying down their debt. If they came back to fair value, that would effectively be the same thing. Default risk with this debt is effectively nil. They have less than 1% effective risk of default per year, which is what we'd like to see. And then profit margins, we have a distribution of anywhere from 15% to 35%. On an expected basis, we see 26 to 27%, which means that they would maintain their higher than average against their industry profit margins, while their sales capital ratio, as we said, would also be less than average, but still get closer to their industrial expectation. That gets us a profit distribution of anywhere from 800 million in the worst case scenario to possibly 3.9 billion or so in the best case scenario. On an expected basis, we see about 2.2 billion. And if we use the discount rate that we've applied across the varying sets of outcomes we have here, that gets us to a present value expected price of $105.47 per share, which is 17 to 18% higher than the current share price. We have 5-year forward value targets unadjusted for the dividends that they'll choose to pay out during that period of anywhere from worst case scenario $78.99 per share to best case scenario $321.41 per share. On an expected basis, we see $180.27 per share, which if you compare that to the current share price, that gets you an implied return for the next 5 years of 15% per year, which is nothing to sneeze at. Pretty healthy returns right there, 15%, not gonna lie. We do have a value score, which is my personal evaluation of the outcomes here, basically taking worst case scenarios against best case scenarios, comparing the expected market return to the expected return of the company, and kind of weighing in both absolute and relative sets of expected returns. I end up with a value score of 0.77, which is a relative measure comparing it to the overall market. I will say that the overall market does have a value score close to this right now. So effectively that means that my assessment says that this company as an individual company relative to taking it on an index is about as good as taking on an index, in my opinion. Though again, it's worth noting that any individual company inherently has much more risk than an index. So even being as good as the index is in some ways a sign that the company's good, but it's not necessarily a super great value. This isn't necessarily something I'm looking to run out and purchase. I do obviously find it to be undervalued. As I've said, I've been an owner of this company before, but I'm definitely not looking to necessarily add a semiconductor to my portfolio at these particular return potentials at this time necessarily. So it's like, personally, I'm looking for higher returns than that, but this is definitely a pretty good returns and a very well run company. As I said, I've been covering it for several years, and so it's kind of one of those companies that I just like to keep updated, partially because of my own history with it, and also because of other people in my life's interest in it. So it's something I just like to keep the valuation up to date on. So that's going to do it for the valuation. Definitely does it for Skyworks here today. Pretty much does it for the stream as well. I'm not entirely sure what I'm going to be doing in the next valuation. Obviously, in the last several weeks, we've been doing polls on the channel in order to decide what company I'm going to be valuing in the next week, though obviously I get to select which companies are in the poll. I will say that the next runner-up in the most recent poll was DR Horton Homes, DHI, as a company, which is another company we've covered in the past. That was the next runner-up in the poll in this last week. So I don't know if that's going to be the company we cover next week, but it very well might be the one. If not, it may be one of the other ones. I know Ingalls Markets was also in the list, as well as a few others, so I'll have those in there at some point. So make sure you hit the poll within, it'll be up there tomorrow. Make sure you hit that poll if you want to have your input on what we should be including in valuations for this watch list. And then if you have any suggestions for companies that I could do in the future, please comment them below. Please also like the stream on your way out the door, and make sure you hit that subscription button as well as the notification bell as well. All right, I'll catch you all again next time.